welcome. You're watching NDTV Profit. I am Mahima Vajrajani, and with me today in an exclusive conversation is Ritesh Tiwari, who's the CFO of Hindustan Unilever. Ritesh, thank you so much for speaking with
my
us.
Pleasure,
my understanding right now, if through this conversation is we want to try and understand as to what's happening in the entire sector, and of course how HUL, being the bellwether of FMCG, can convey to people as to what's happening in the space. My first question to you is that FMCG as a sector has been under pressure in the past 1.5, 2 years because there is demand which is weak. There's volumes which are elusive right now. There's also inflationary pressure playing its role, competition playing its role. I want to understand as to what is the kind of strategy in place for you right now in terms of what could be the next line of growth for HUL, and what are the discounting strategies especially in place when it comes to competition?
Yeah. So two things are changing, Mahima, overall. First of all, the overall macro conditions in FMCG are improving. So when you look at good agriculture outcome we had both for Kharif and Rabi crop with a good monsoon, overall food inflation, which has been very stubborn for some time, has come down in the country. The monetary easing that government has done, the amount of tax relief that people have got as per the budget latest. If I add all those elements put together and then I look at headline commodities, large commodities, like crude oil, crude palm oil, they also have come off from their peaks. So all put together, overall macro conditions which supports demand is improving. There has been in the past year a purge in overall disposable income and the real inflation which has happened. So all put together, the consumption, as you mentioned, has been not as good. But the way we see going forward, the conditions are improving. Equally, what we have done as Hindustan Unilever, we have done a lot of work on our portfolio, especially in categories like beauty and well-being. And so that is one reason why we do believe that going forward, the trading atmosphere will be better than what we had in the past. Second, channels are changing and getting disrupted at a very high pace. Organized trade is growing much faster than general trade. We have also pivoted our portfolio and our investments towards organized trade. So put together, when I look at both internal factors and external factors, we do see overall trading conditions improving, demand outlook improving, and hence also our own performance we expect. Let me say the first half of financial year 25-26 should be better than second half of financial year 24-25 which just went by.
Right. You mentioned that, right now your modern trade is doing better than your general trade, and quick commerce has been a disruptor when it comes to, how trade happens right now. It's a structural change that we're observing. Just wanted to get your sense there because now quick commerce is really picking up. You might have to change your inventory model. How has that impacted your working capital? Has that, already taken place, or is it still impacting your working capital? And do you think that overall your distribution strategy that is there right now in place will change going forward as well?
Yeah. See, overall, if I take a step back, the construct of the business from channel perspective is still 70% general trade, 20% modern trade, roughly 7% e-commerce, and then 2-3% other channels. Quick commerce within that for our business is roughly 2%. It's small this point in time, but growing very rapidly. And hence we are also growing very rapidly in quick commerce. Portfolio, we are expanding. So as consumers are adopting quick commerce as a channel, we are also increasing our assortment in quick commerce. We are increasing and improving our customer service. The way number of times end up serving a place has also further increased. Investments in channels of the future, be it modern trade, be it e-commerce, overall across all the ports has also got dialed up. So ultimately for us, we are in the business for selling soaps, shampoos, our various products, and hence we are very consumer focused. Now, wherever consumer journey of shopping is changing, we have to respond to that and ensure that we are fully present wherever consumer journey takes them to shop. And hence today, organized trade is doing much better than general trade in terms of consumer shopping experience and journey. We are doubling down on this point in time on organized trade. So investments are going up, customer collaborations are increasing to ensure that we are present with full-on portfolio in organized trade.
Right. And in terms of price points there then, because right now, both in e-commerce as well as quick commerce, what I'm seeing is that there are a lot of players in the unorganized space, especially startups, which have really come out and done well in terms of your ice cream business or your beauty and wellness products. How are you viewing that as competition, one thing, and then how are you, placing discounts and prices in place to compete with them?
Yeah. See, India, when you look at overall competition, there's every kind of competition in the country. We have large multinationals in the country, almost all of them operating in India. We have large Indian conglomerates into FMCG. We have amazing listed companies doing business in FMCG. We have very good regional and local brands across the country which does business. And then exactly to your point, the entire D2C industry which is also playing. It is pretty comprehensive competitive landscape. Working with this competitive landscape, in last 4 years, we've added more than 200 BPS corporate market share. As HUL, we have a portfolio which straddles across all the price pyramid, from premium to mass. And that portfolio completeness helps us to compete across channels and across all the competition.
Okay. So then in your premium portfolio, what you're also doing is you're making smaller packs of those premium portfolios and selling in the rural markets, because rural markets are right now doing better than urban markets, right? So just wanted to understand as to how sustainable demand is for those premium products in the rural markets, considering this rise. I mean, are they willing to pay at this price point? And secondly, in terms of your volume and value growth, do you think that the next leg for FMCG will be more of a value-led growth rather than a volume-led growth because of the kind of structural change that we are seeing in terms of demand?
Yeah. So the rural consumption habits are dramatically changing. No longer, let me say, take an example of beauty. No longer a moisturizer like Glow & Lovely and talcum powder is the beauty quotient for a woman in rural area.
Correct.
Even a rural consumer who wants to use beauty products ends up using 3 to 4 different products on the face to complete the beauty regime. And which is why it is very important for us that we are able to make all formats of beauty products accessible. And for that matter, many more premium products accessible to rural consumers. It typically happens by making a small pack of a premium product. And this is how we end up penetrating into rural areas. And we have seen that success across. So Dove Bar, for example, it's a premium soap bar. It gets sold in cities. It gets equally sold in a smaller pack size in rural areas. And we have developed such access packs for all premium products for multiple categories to cater to rural consumers as well.
Right. And beauty and wellness is one of those segments that's doing well for you. So just wanted to get a sense there as to, in terms of growing this particular segment, what's the plan in place? Do you think it will be done via acquisitions, or there are new products that you'll be launching? What's the next course of action there?
So there are 2 big actions that we're doing for our own portfolio within beauty well-being. First of all, massive amount of portfolio transformation. And we deploy all the 4 strategies for portfolio transformation. We take our large brands and then we enter into more demand spaces. So for example, take Vaseline. Vaseline has entered into sun care space. So that's one strategy that we do. We've taken Pond's. Pond's has entered into multiple demand spaces of sun care, light moisturizers, serum as a format. So you take large brands and get into more demand spaces. That is strategy number 1, to expand the portfolio. Strategy number 2 is to see if at all there's a demand space, you don't have a brand, then we want to launch a brand in that space. So Novology is a classic example where we saw space in masstige, premium skincare. We wanted to have a product and range. We used our global technology and we launched Novology as a brand in that space. So that's the second strategy to improve portfolio in beauty well-being. Third then is to look at the brands that we have in stable of Unilever and what is relevant for us to bring in the country. So for hair, for example, we just recently brought Nexus from the global portfolio. We launched in hydration space Liquid IV. Sometime back we bought Simple Love Beauty Planet from stable of Unilever. So we do bring brands from the stable of Unilever which are relevant in the country to expand the portfolio. And where we can't do the job from these 3 strategies, then the 4th strategy always is then to go for bolt-on acquisition. So we acquired, for example, Oziva a couple of years back in health and well-being space. Recently we acquired Minimalist in masstige, actives, science-led space. So all these 4 strategies will keep deploying because beauty market in India, it is fragmenting. And typically when you have a per capita consumption which is low, which is where India is today at $50 per capita, as market keeps improving with overall rising income levels in the country, we have always experienced in multiple countries in the world, skin care takes off. The market fragments, penetration improves, consumption levels also increase.
Understood. And, since you mentioned that you will be making investments, in growing your segments, just wanted to get a sense, as of FY25, when I was seeing your balance sheet, cash and cash equivalents was roughly 7,500 crores, right? And HUL is known for its dividend payout ratio as well. Just wanted to get your sense as to what is going to be the cash distribution policy like, because right now shareholders might be expecting something from you in terms of returns. What is there in place in terms of dividend payout, as well as is there a buyback on cards how do you plan to pay back to your shareholders?
So the way we look at overall capital allocation a little more broadly, and there are three components to that. Component number one, when we generate cash, first port of call is to deploy cash to grow the business. So in terms of investing for capital, investing behind brands, innovation and capability. So that's where we do our first deployment of capital. Second, we deploy capital to drive bolt-on acquisitions. So Oziva, Minimalist, a classic example where we have a need to deploy capital to further improve the overall portfolio that we have. And third, we always believe in maintaining high dividend payout. We always have more than 90% dividend payout ratio. We have done for the last several years. Once in a while, when we do believe there's a little more cash that we'd want to give back to shareholders, we then go and do special dividend, which is what we did last financial year. So those are the strategies that we end up using to ensure that we end up giving healthy dividend back to shareholders. Ultimately, we have to ensure that shareholders get a very healthy return on capital, be it ROCE, which we always have maintained more than 100%, or for that matter, a very healthy ROE, return on equity. In last 4 years, we have done almost 400 BPS improvement in our ROE.
So that brings me to my next question. What are the ROC and ROE targets that you have for the next, let's say, 2 years down the line? What is the internal targets that you're aiming at right now?
So the ROC, we want to maintain above 100%. And when it comes to ROE, return on equity, as I mentioned today, we are at roughly 21.2%. We've improved last financial year by 120 BPS. We will want to keep making progress by improving 100 to 200 BPS going forward as well.
Okay, and in terms of acquisitions that you mentioned, will that be only in beauty and personal care segment? Because foods is something that's a segment that's remained under pressure. Do you think that segment plus your home care segment, will you be going ahead and making acquisitions there, or will you be adopting a strategy of introducing new categories or introducing new products there?
Yeah. As I mentioned a little while ago, for us to improve portfolio, we will do all four strategies across all the categories. Be it expanding our big branch into more demand spaces, even home care, for example. We've taken Vim, our very large brand, which is in dishwash, and we launched Vim Floor. We have now, second item I mentioned to you earlier, that the second strategy always is to launch new brands where we don't have in a demand space a brand. So we now launched Sun within home care as a dishwash brand for tier 2. And equally, let me say example of foods, where we brought Hellmann's from the stable of Unilever. And coming to bolt-on acquisitions, both beauty and foods are our two priorities for bolt-on acquisitions. We do believe that our portfolio today in home care is complete, and where we had space, we have launched Rin Liquid. As far as tier 2 liquid is concerned for laundry, we launched Sun in dishwash. So we do believe we have a complete portfolio in home care, which straddles across the entire price pyramid. That is similar case in personal care as well. But foods and beauty are the two places where we have to continue to do more work in terms of transforming portfolio.
So
beauty, if I just probably capture overall one thought, Mahima, out here, as HUL, we are over-indexed on premium. There's one place where we are not over-indexed, which is beauty. And so hence beauty and well-being, you will see in next few years' time, we will make 900 BPS improvement in terms of contribution of premium products within the beauty business. And which is why the job of transforming portfolio, using all the four strategies of portfolio transformation, we will continue doing that job for business in beauty.
Okay, interesting. So then that means that the next leg of growth or lever will be from beauty and segment. Is that the right reading?
All of our businesses, if you look at, there are 4 different segments we have. Home care, beauty well-being, personal care, and foods and refreshment, which we call foods now. All 4 segments we see growth potential, and we'll grow all the 4 segments. The strategies that will be deployed to grow different segments will be different. Beauty well-being definitely has a job of being accretive to overall HUL growth, just because the sheer amount of low penetration and high consumption opportunities for us to keep dialing up, and which is why our investment decision of dialing up more investments behind beauty and well-being.
Right. Okay, understood. And in terms of having a competitive advantage, supply chain is something that one needs to have a control on, and HUL has been bang on when it comes to supply chain control. Just wanted to get a sense as to what's the next plan for capacity expansions. Will you be doubling down in terms of adding manufacturing capacities, or will you be outsourcing them and adopt a capital asset light model?
Overall, we believe that now is the right time. The conversation I had earlier, both looking at internal factors of the work that we are doing with our brands, our portfolio, and external macro, now is the time to dial up further investment across all lines of the P&L and balance sheet. Coming to capital, CapEx, we have typically done 2% of CapEx expenditure to a turnover as a ratio, as a percentage. We will increase that now more closer to 3%.
Okay.
And the incremental investment will go behind multiple things. It will go behind capacity for growth. It will go behind capacity for innovation. Equally, to drive more productivity. We continuously look at our infrastructure in the country, how we can optimize to make our products produce more closer to consumers and in a more cost-efficient way, and it travels less number of kilometers. So hence there will be investment done for doing that as well. And last but not least, to dial up customer service. The point we spoke earlier about organized trade. As organized trade is becoming larger, it's a different way you end up servicing organized trade. So there will be investment needed for that. Even our general trade investment levels, we are increasing to increase our service levels there as well. So launching Shikhar, going to a go-to-market model like in Chennai, like in Mumbai, more direct to a Kirana store with the support of our distributors. So those are also spaces we are making investments.
Okay, and all this will be done through internal accruals, if I'm not wrong.
Sorry?
All this will be done through internal accruals, if I'm not wrong.
We have a pretty healthy balance sheet, so we'll be able to invest. So when we bought Minimalist, it was bought through internal accruals, and all the capital expenditure that we want to do, as I mentioned, we want to increase from 2% to 3%. We will do that with internal accruals.
Right. And in terms of growing your top line, because your sales CAGR in the last 3 odd years has been around 7 to 8 odd %. Just wanted to get a sense as to what's the target like, not for FY26, but from a longer term perspective, 3 years down the line, what's the kind of CAGR growth in terms of top line as well as bottom line that you're expecting? Because considering the investments that you're also doing, bottom line might see some kind of impact, but overall top line should be boosted because of those investments. So what's the CAGR growth that you're penciling in?
Yeah. So a medium to long-term intention is to ensure we are able to drive double-digit EPS growth. If you look at the last decade, our double-digit EPS growth was driven by top line and bottom line improvement. Going forward, the way we see, it will be a double-digit EPS growth, but driven by top-line growth and modest margin improvement. The latest guidance that we gave of our EBITDA, which will be more now trading into a 22 to 23% zone, that's for next few quarters.
Yeah.
But if I look at medium to long term, we will keep making modest margin improvement. But growth of EPS will be top-line driven. India has seen 7 to 8% in the past. Typically market growth, and this 7 to 8% market growth has come roughly half from volumes and half has come from price. As we speak today, overall climate and overall where commodity levels are, we don't see high levels of pricing. We see more modest pricing, and our own outlook is low single-digit pricing outlook. But we do believe, compared to last decade, FMCG industry will grow faster compared to what it has grown in the last decade. The sheer amount of consumption headroom that we have in the country, the entire India growth story, the demographic dividend of the country, we do expect all of that will augur well for FMCG. So I do expect FMCG industry to grow faster in the next decade compared to the previous decade. And our stated ambition always is to grow ahead of the market. And so we called out at least 100 BPS will grow ahead of the market. So this is where we do believe that a combination of growing ahead of the market growth improving, and over a long-term basis, we have seen 3 to 5% pricing coming in, which is not there now, but it will come back sooner or later as commodities do stabilize. And hence a combination of volume-led growth and price-led growth with modest margin expansion should help us to drive basically EPS growth, which will be in double digit.
Okay. In terms of, there was an interesting EY report that I was reading which said that 52% of sales right now is happening in private label goods, right? So I wanted to understand as to what's happening there in terms of your organized versus unorganized market, and in terms of HUL being a bellwether, how do you plan to, convert that unorganized market also into an organized market? What are the strategies in place?
So this is overall Mahima secular trend. Overall in FMCG, portfolio is getting more premium. So getting entire across all categories, portfolio becoming more premium, that's a secular trend in the industry. Conversion of, let me say, loose tea to packaged tea, unorganized to organized, unpackaged to package, that is a trend which also is secular. It will keep happening. Places where this is more relevant, the shift is, I would say, is in skin cleansing. It is in, let me say, mass laundry, and it is in tea. Apart from that, bulk of the categories already is by and large organized. So, and at any point in time, there will always be players in all the segments. The point I mentioned that with HUL, we have a portfolio which straddles all the price pyramid. So today our portfolio is complete across all the categories. So we are able to compete with all kind of competition.
Okay, and one last question is that a lot of concentration right now is from D2C brands, and they're moving more towards personalization when it comes to their marketing strategy as well. So just wanted to get a sense there as to what is the marketing strategy in place right now, and how are you adopting to those changes?
Yeah. So a key focus now is to have a very renewed way of looking at our portfolio and growing in the future. We call it as core, future core, and market maker. Roughly half of our business sits in core. These are our large brands like Lifebuoy, or our businesses which like sits in shampoo sachets. Then you have future core business, and think of shampoo bottles which sits there, Lux brand which sits there. And then we have a market maker portfolio. That market maker portfolio today is almost a 7,000 crore business for us. And the way we see that 80% plus growth going forward for us will come from future core and market makers. Okay. And we'll keep doubling down our growth in market maker. This is the portfolio today which competes with D2C business by and large. This is where mass stage skincare sits in. This is where liquid sits in. This is where future formats of products like serum sits in. For us to compete across all the segment, it is not only important to have portfolio which is present. And as I mentioned, we are dialing up where we need to dial up, like in beauty, by 900 BPS, we'll increase the contribution of premium products. But portfolio is only half of the story. The balance half of the story is, do we have capability end-to-end to drive a profitable, sustainable, long-term business model for driving growth in that segment? And the answer to that is work that we do across supply chain, work that we do across channels of the future in trade. So let me give you an example, supply chain. We have now 7 factories which we call as nano factories. This is basically creating a supply chain for smalls. When you have that nano factory, which is housed within a large mother factory, it gets all the efficiencies of the large factory, but it has nimbleness and volume and agility of a small supply chain. So you have efficiency of a large supply chain with nimbleness and agility of a small supply chain. This is mission critical in case you want to then have a very sustainable business model for competing in niche segments as well. So our own business, which is today 7,000 crore business in market maker, if I click down into beauty, we have more than 2,000 crore business which sits in our 6 big bets in beauty, which sits in premium, which sits in, let me say, light moisturizer, sun care. These businesses are profitable. They make double-digit margin. So which is why it is very important to have a portfolio which caters to that consumer demand. Equally, there's end-to-end go-to-market structure of supply chain and distribution in customer development that supports this entire structure to make a profitable, sustainable, long-term business.
Okay, so Ritesh, one question that I had about your ice cream business was that now you've got the NSE and BSE approval also for the demerger of Quality Wars business. Just wanted to get a sense as to what's happening there. How do you plan to grow that business once it's demerged, and what are the plans in place?
So overall, Mahima, the plan that we have for ice cream business, we want to demerge the business and we want to list it. And hopefully with all the regulatory approvals and internal separation job that we have to do, we should be able to complete the job by March quarter 26. The whole idea behind that, see, ice cream is a high growth, but equally high capital intensive business and low margin business. It has its own distinctive business model where it runs on a cold chain, both for manufacturing and for distribution. And hence we believe that having a business which a focus management, which is then able to deploy strategies which is suited to the distinctive business model of ice cream to ensure that we're able to create value differently, and hence the whole reason why we're doing what we're doing. And the business has today amazing amount of brands. It will continue to get support on portfolio, on brands from the global ice cream company, and we will continue investing in the business. Even in the current ice cream season, we have disproportionately increased our footprint of cabinets to serve more consumers across the country. And last quarter, we spoke about having a double-digit growth in the ice cream business. All the shareholders of HUL will be able to participate in the value creation of ice cream. The board, when it came up with the scheme which we announced and which is what is getting approved as we speak now at various forums, it will have a 1:1 share entitlement ratio, meaning every shareholder of HUL will get 1 share of the ice cream company, and hence all shareholders now will be able to create value with the ice cream opportunity.
Okay. And your sense in terms of competition in the ice cream space, because right now what I was observing in the quick commerce space, there are a lot of startup companies which have come up with their ice cream businesses. For example, there's Go Zero, which has made its mark in terms of the quick commerce space, not otherwise. What's the sense there, and then what will be your distribution strategy like in the ice cream business?
Yeah. Our ice cream business today has a footprint across channels very different than market. We are over-indexed on channels of the future. quick commerce, modern trade. So our overall business is more premium and it is more over-indexed to channels of the future. Ice cream as a category has overall low penetration, low consumption in the country, and hence massive headroom for it to grow, and hence multiple players can coexist and keep growing the market. So far as you have distribution, which is wide, we are present across the country. We are present across the channel with over-index presence in channels of the future, and great amount of brands and innovation. We do believe that with low penetration, low consumption in the country, there's enough headroom for us to grow the ice cream business. Okay. In last 1 decade, the business has grown at double digit, and we do believe that going forward as well, it's a business which we would expect to keep growing at double digit, and which is why having a business model which is suited to deploy the distinctive business model and strategies for ice cream will serve the business very well going forward as well.
Right. I think the key takeaway from this conversation is that although FY25, FY24 FMCG was under pressure, but the future definitely is promising for the entire FMCG industry, and the fact that HUL is strong in terms of growing in terms of double-digit EPS growth is the key takeaway for me in this conversation. So thank you so much. Ritesh, you want to add
No, indeed,
something to
Mahima.
that?
I think I'll just probably add to what you mentioned, that where we are today, both macro factors for consumption for FMCG are improving. I mentioned multiple reasons for that, be it a good agriculture outcome or inflation, which is looking now much lower compared to earlier, especially food inflation. The amount of monetary easing which has happened in the economy, plus the tax relief. If I add all those elements put together, a good climate getting created externally. Internally, what we have done with our work on portfolio channels, we do believe that external internal factor put together, the outlook for FMCG consumption and our own growth outlook will be better going forward. As I mentioned, the first half of financial year 25-26 would be better than last half of financial year 24-25. We will invest in the business. For next few quarters, we do believe our margins might come down more to 22-23 band. It is still very healthy, but we want to ensure that we are unblinkingly going behind growth. And growth for short term will be volume led, to your question which you asked earlier.
Yeah.
And pricing might be lower at low single digit, but it will be volume led growth.
All right. Okay. Got it. All right. Thank you so much, Ritesh.
Thank you. Thank you, Mahima.